Hello from all of us here at Robare and Jones. Hope you all are doing well. Wanted to take a couple of minutes today to give you a quick update on the markets, some of the things that we're seeing in the markets, and what we're going to do to the allocations here next couple of days, some of the changes that we're going to make. But first, I want to give a quick update about the office. Most of us are still kind of switching our time between being here and working remote. We expect that to continue in the foreseeable future. And alongside that, we expect to continue to conduct our meetings with clients via web conference. Looking forward to that being over. It's been a long time since I've seen a lot of our clients and getting kind of tired of talking to this black bar over my monitor. Really looking forward to shaking your hands again and hopefully sharing a pork chop together very soon. But first, the markets. The markets are high. Equity markets have had a record year, and they're setting new highs every other day, it seems, and in 2020, but also in January, we're continuing. But interest rates are very, very low. So if we're looking at just the PE ratios of the indexes or of the equity markets as a whole, then yes, they are expensive, but that's only a little bit of the story. The other part of that story is interest rates. Now, the Fed has been keeping interest rates very, very low. They've been at or near zero since March, roughly. And they've come out and said that it's going to be that way for the next 2 to 3 years, perhaps even four, with the new administration. So we've seen evidence of those monies that were in the treasuries moving away from the treasuries and going into the equity markets. That drives prices of treasuries down and their yields up a little bit, and equity prices up as well. So the last couple of months, I'd say last 6 to 7 months, we've seen about a 30% uptick in the 10-year treasury, which is indicative of that money moving from a non-producing asset to a producing asset. So I want to take a little bit of time just to talk about some of the updates we're going to make to the allocations. The first one, the biggest one, is that because equity markets have done so well in the last few months, we're going to bring some of that equity exposure down. So we're going to be selling about 2% of equities and reallocating them towards fixed income. But we are going to retain about a 1% weight to or overweight to equity. So 51-49% fixed income, 51% equity, and a 50-50 type of a model. And the equity portfolios, biggest change we're going to be making is a greater allocation towards developed international equity. Doesn't mean that we're no longer liking the domestic market. We're still overweight US, but we're just increasing our footprint a little bit there. And it's really based on where valuations are. Valuations for the same earnings, you can get the same earnings for less money in the developed markets outside the United States. And I think that there's some opportunity there, both diversification, so protection, and source of return. On top of that, we are increasing a little bit our exposure to value. So some of the sectors that haven't done so well the last year, that haven't fully recovered to the same extent that, say, a growth company like Google or Microsoft or Amazon has. Increasing exposure to a sector like financials. But overall, our domestic equity is going to stay about the same. We are reintroducing and increasing our small cap exposure. Emerging markets, we are bringing that down a little bit, and that's really just to kind of make room for some of the extra equity that we're putting on the table. In the fixed income, we're going to be reducing our exposure to high yield, but retaining a little bit overweight. We introduced high yield into the portfolios early last year when spreads between treasuries and high yield were about 6 to 7%. Those spreads have come down, meaning high yield has gone up, and the difference between the very safe high yield and the dangerous, I would say dangerous, but at-risk yield, I would say, that has come down to a much narrower divide. So we're taking some of those gains and reallocating them to more AAA or investment grade investments. And just provide better, again, we're taking risk out of the portfolio to provide a better ballast. Wanted to keep this very short, but I also wanted to, let you know that we really appreciate the trust that you put in all of us. We look forward to the day where we can see each other face to face and share a pork chop. I just wanted to give one final thought on 2021 and our expectation here. I think diversification is going to be very, very important, not just in your fixed income alternatives, equity mix. It's going to be extremely important within the equity markets. I think that this year we might see some divergence in the sectors and some of the things that we've seen the last couple of years, where you basically underperformed if you weren't all in growth. Um, but we want to be careful about that as well. So the changes that we're going to be making are going to be over time. Um, Again, I wanted to just thank you and welcome you to give us a call if you have any questions or if you feel like it's time for a review. Feel free to get in contact with Anne and she will put you on the calendar and we look forward to meeting with all of you. Have a great day. Have a great week and we look forward to seeing you soon. Bye bye.